Thank you. Thank you. Good morning. Well, welcome to Seattle. I had an easy commute this morning. I just live in the next town over, and I see some friends from BECU and maybe some others. Those of you that drove here to help our community and our economy, thank you. Glad that you're here. So, sounds like you had a good day yesterday from what I read on Twitter. My Twitter handle's up there for those of you so inclined. I spent about 20 years helping to grow a $6 billion financial institution to one of $400 billion. And for the past 5 years, I've really been at the intersection of financial services and fintech. And we're going to talk a little bit about that today and talk a little bit about innovation. And I'm going to start here, though, and kind of zoom out and ask you a question. What happens when our maps don't match the landscape? So this is a representation of a map from 65 AD. Now, I used this in Milan last year, and my Italian friends told me the map looked perfectly accurate to them. I'm not so sure about the rest of us. The art and science of cartography would advance over the next millennia and a half as explorers would sail around the coastline and kind of note how it jots in and out, and the coastlines would get more and more accurate. But yet, a big, what we would now know as an inaccuracy would prevail, and that's this notion of this great oceanus surrounding, the giant ocean, surrounding all of the land masses, beyond which there is, well, nothing, right? A great abyss, perhaps sea serpents, something like that. So imagine even as late as 1500, an intrepid explorer setting sail from one of those European ports, a little early in the morning. Of course, the elite explorer has the best ship with the best crew, most well-appointed, funded directly by the king and queen. They get out in the stiff early morning breeze. The other two ships follow shortly after. As the day goes on, that lead kind of extends a little bit more, and the second two ships can't see the lead ship any longer. They can just see the sails. And a little while after that, they can just see the tip of the mast and the crow's nest. And a little while after that, it too drops beyond the horizon, and the other two ships can no longer see their leader. What do you think they think happened? I think he sailed off the edge, right? So what would you imagine their response to be? Yeah, turn around and head back. I told you this was a dumb idea. You sailed off into the edge, eaten by the sea serpents. This was a terrible idea. And of course, we now know there was no edge. There were no sea serpents. They went on to discover new trade routes and new lands, and they're taking that risk. And it seemed incredibly risky at the time because of the maps they were using to navigate the landscape. And it would be 450 years before we could really get a view of this blue marble we now call Earth. And no, of course, there was no edge. Yes, there are oceans all around, but if you keep sailing, you'll come back around to another one. And the reason I start with this story is you think about how accurate you're navigating with your maps if this is your whole world. I'm not so sure this is the right border, and neither is this. And by the way, a note about the B word. So I will say the word bank. I know I'm not at a banking conference. I work with banks and credit unions. Believe me, I understand the difference. But will you please just indulge me, if I say bank and banking, because you'll tell me, oh, we bank him, right? We know him, all that stuff. So I'm meaning you too. But whether it's these guys or your industry or everything else, I'm not sure that's the right map we need to be navigating, because we are in a whole new landscape now. We're in a landscape where Amazon, another fine local company here, is now in the merchant service business, where a coffee company has $1.5 billion of prepaid funds that aren't in your institutions, an outstanding payments experience. Now, Uber's in news for not so good things lately, but you can't argue about the customer experience, and you can't argue about the growth that they've had. Example of their screenshot in the lower left. How many people use Uber? Yeah, I like to ask that because it's always nearly 100%. 5 years ago, if I would have told you that you were going to go out to the curb and raise your hand, not do that anymore, you're going to pull your phone out now instead, push a button and a car would come for you, you told me I was crazy, let alone if I would have predicted that it would have put the yellow metal taxi business out of business, not out of business yet, but filed for bankruptcy in the city of San Francisco. I'm working with a credit union in the Northeast that actually finances taxi medallions. Look what's happened to the value of those as assets. An app, a little set of pixels on the phone in all of our pockets, has changed a very physical business of driving people around in metal automobiles. And you'd probably be crazy if I told you, thought I would be crazy if I told you that pretty soon, then that car will arrive with no driver, but you all probably know that's happening right now in Pittsburgh and a few other cities where they're testing that. So we got to think a little bit broader and not just thinking about what are the things that we've done and how do we get better at that? Because success is ultimately a poor teacher. What got you to this stage may not at all be what gets you to the next stage. Right? Doing those things over and over again that we've done, and I was just talking to Chris this morning about doing the same things over and over again, expecting a different result. That's Einstein's definition of insanity, but yet we all kind of fall into that. And so most of my career, and probably most of your career, was marked by rising asset prices, falling interest rates, in an era of deregulation. Now that part certainly isn't true anymore. We've kind of recovered around the asset prices. Interest rates will go up from here, are going up already from here, but we're certainly not in an era now of deregulation. We're in an era of re-regulation. Then came 2008. And we think of it as the global financial crisis, and that it was. And that's where we got focused, is on internally, how do we do better all those things that we've done for the prior decade or century or centuries. But think about the rise of technologies during this time that have fundamentally changed not only your business, but your members and their expectation. It was not just kind of a little bit different about the game. It's really changing the game. If we look at Porter's 5 forces and think about the impact on the industry, we go through all these. We could talk about every one of these and how they're impacted. Today, I only have time to talk a little bit about the threat of substitution. And that's something we have never had to deal with in our lives until the past few years. Sure, we had big credit unions and small credit unions. We had banks and we had savings and loans and all those kinds of things. But let's be honest. Those are all just slightly different flavors of essentially the same thing and essentially the same business model. Your strategy works until it doesn't. So this executive said, we're strategically positioned better than just about anybody out there. Never in my wildest dreams would I have aimed this high. Well, maybe a little higher would have been good. Now, it's easy in retrospect to pick on Blockbuster. That was a great company. They were opening a new store every 24 hours, a peak of 8,000 stores, and they were better at executing that business model than anybody out there. I mean, for those of you that are old enough to remember what video stores were like before Blockbuster, they had a couple of hundred tapes at best, and these were tapes at this point, right? At best, if your number one wasn't there, you didn't get there in time, and it was rented out, you were down to choice number 9, which was, some foreign movie you've never seen before and can't understand because it doesn't have subtitles. They executed this model better than everybody else. Their strategy worked until it didn't. Right? In 2001, Reed Hastings, 1997, Reed Hastings, an engineer in California, rented Apollo 13, an apocryphal story. It kind of says, well, it's not exactly true, but allegedly the story goes he had $40 in late fees, was so pissed off he started his own company. We all know it is Netflix. 2001, he actually offered to sell Netflix to Blockbuster for $50 million. They declined. So your strategy works until it doesn't. And think about what that strategy was. It was about having location, 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 physical space, the best physical space in the right locations in the most convenient neighborhoods, bright, airy space with well-trained staff that, they had human recommendation engines. at that time. Oh, you like that movie? You might like this one. It was directed by the same person 5 years before. You didn't get a lot of press, but I bet you'll like that. And then fundamentally, things change. So thinking about our industry and that location-based business model, in the blue would be what you saw in 2014, and frankly, every year before that I know of. When you ask customers, and again, here's the B word, but this applies to you too. What is convenience? Number one answer, branches near me. And in 2015, for the first time, it wasn't the number one, even the number two answer. It dropped to number three. The number one answer was having a leading online and mobile offering. Netflix didn't beat Blockbuster at their own game. They changed the game. The technology is changing our game. Look at what Bank of America released in their fourth quarter earnings here. Now, this is quarterly. They're adding 500,000 to 1 million active monthly users every quarter, and their percentage of total deposit transactions that are taking place on the phone instead of in the branch are ticking up and up and up and up. And I'm telling you, folks, we're still in the very early stages. This isn't going away. How many people have read The Innovator's Dilemma? Yay, that is awesome. That is more hands than I normally see in a financial services audience. That's great. I've been asking this for about 5 years on the speaking circuit now. I normally have no more than 2 or 3 hands go up. So maybe word is getting out, but I'm glad that you read it. The essence of The Innovator's Dilemma is this. I have a real live business today, real live customers or members buying real live products right now, generating real income today. Why would I divert any of that towards something new and unproven and seemingly risky? Yet if I don't do that, maybe I'm going to fall behind. Maybe I become the next Blockbuster. That's exactly the dilemma. And it's not an easy one. And we're certainly facing it here. I wrote about it 4 years ago now in American Banker. So in the book, Christensen talks a fair amount about the steel industry. And prior to the late 1970s, there was exactly one way to make steel. It involved about $1 billion worth of a very expensive integrated steel manufacturing plant. You know, 2 kids in a garage weren't getting up to say, I'm disrupting the steel business tomorrow morning. Right? It was pretty tough, really high barriers to entry. But new technology did emerge from Asia, the mini mill technology. Now, mini mills could make steel for 1/10 the cost of an integrated steel manufacturer. There's one catch. They can only make one kind of steel, and that was rebar. So that's the lowest grade stuff. That's the crisscross, metal bars inside the concrete beneath our feet here. That was the lowest margin, lowest part of the food chain. The steel industry actually said, thank you, that's great. Take that off of our plate because we'll be able to move up the food chain then and we'll sell more profitable things. But what do you think happens with a 90% cost advantage? Well, they reinvested that and pretty soon they could do rods and bars and then structural steel and I-beams and that sort of thing. Before too long, the only thing left was flat-rolled steel. That was the highest part of the food chain, the highest margin business. At that time, Bethlehem Steel famously doubled down on flat-rolled steel. Said, okay, forget all that other stuff that was all low margin. We're just going to corner the market. But they still had this very expensive infrastructure and process. And it worked for about 1.5 years, 2 years. And then Bethlehem, like just about every other steel manufacturer, went through very, very painful restructurings and bankruptcies and layoffs. I don't have to tell you. I grew up in the Midwest, and we all knew somebody whose family member was a steel worker, and then we all knew somebody whose family was an ex-steel worker. And those jobs weren't coming back anytime soon, and they're still not coming back, despite what some people are saying today. The business has been fundamentally changed. So the steel business, what's that have to do with us and the credit union? Well, we're going to talk about fintech. And when we think about fintech, we're still in the rebar stage. So isn't that cute? Those 2 kids in the garage have that app. Oh, our members wouldn't want that. Are you sure? They probably have it already. And even if they don't today, even if you're right today, how long are you willing to bet that you're going to continue to be right? because the game is fundamentally changing. Fintech is hot. Over $40 billion invested in fintech companies, equity capital over the last 3 years, increasing. 2016 was actually down a little bit, but the trend line is still very much up. And for the most part, the industry is not. I see three groups of financial institutions: leaders, learners, and laggards. Very few leaders who are really embracing an innovation and trying new things. Quite a few in the middle, actually growing group in the middle. I spend a lot of time with those. Those are people that know they need to do something, even if they're not exactly sure what to do. They might need some help. And we still have a long tail of laggards that are, frankly, in denial. Oh, that won't impact us, not our members. McKinsey charted this up, and do you see this as a threat or an opportunity? I think it's both. McKinsey thinks it's both. And to some degree, the answer is it doesn't matter, because the penalty for ignoring it is just the same. There's an opportunity to reduce costs and to improve your member experience, but if you don't do it, these things are already happening on the edges and outside of the industry. So we've got to pay attention to that. And all this could add up to be a big number. Well, there's a big number. That's what Goldman said. It's going to take off of the revenue stream of financial services sector about $4.7 trillion of revenue. So here's the good news. The industry will survive. I'm not going to sit here and tell you about a future without credit unions, a future without banks, and no more branches and all that stuff. I don't think it looks that way in the future. But don't take too much solace in this, because that's not the real question. The real question is, will you survive? Or will you face your own Kodak moment? Right? Kodak, clearly the best manufacturer of celluloid film in the world. Maybe Fuji film might give a little bit of an argument to that. They didn't need to get better at doing the stuff they were already doing. Guess what happened? The game changed. Just like we were talking about Blockbuster. And by the way, interesting footnote a lot of people don't realize about Kodak. It's not that they were surprised by digital photography. They actually were a pioneer of digital photography. The real challenge was steering that massive ship into a new business. And you're all facing that challenge too, and I'm going to talk more about that before I'm done. All right, so what do we do about all this? If you buy that and you say, yep, I agree, we are in this era of digital disruption, what do we do? Well, the good news is you don't have to be out on the bleeding edge, but you do have to close the gap, because your members' expectations are getting higher and higher all the time, not just from financial providers, but from the Uber and Starbucks and Netflix experience, some of those companies we've talked about, Amazon and others. And their bar of expectation is constantly rising, and you have to keep that gap from not being quite so big. So we got to keep up. So why do customers like fintechs? This was a survey done last year, Capgemini, EFMA, World Banking Report, and they asked bankers, I think it was about 900 bankers globally and about 14,000 customers. And on the far left, you see, yeah, ease of use, yep, we both see that. Speed to market, I don't think they asked the customers that. The bankers came up with that one. But as you get to the right-hand side of the chart, the gaps really get quite a bit bigger. So let's drill in on that a little bit. This good service or good experience, the customers say, yep, that's why we like fintech. And the banker's like, that's not it. Or we don't really even understand what our customers are experiencing or what they expect in many cases. This quick turnaround, faster service, personalized, more features. And again, I'm not sure they asked the bankers this question here, so I won't focus on the last one. But if we don't even understand our customers and our members and really understand what their expectations are and what they're receiving from others, how are we going to close that gap? And how are we going to respond? And how are we going to take control of the game that's changing? So that $40 billion that I talked about that's been invested in fintech companies. Yep, there's the occasional story of those two kids in a garage that grew what we like to call a unicorn, a company now worth $1 billion. Those are very, very few and very, very far between. And so it might be easy to say, well, that's not going to happen very often, and we'll have plenty of time to react to all that. But I think there's a couple of things you're not seeing when you think about fintech. And one is, think about how this has empowered others from outside the industry, well-funded players, and we've talked about some of those, right? The Amazons and the Starbucks, and look at Facebook and Google and how they're creeping a little by little into some of the financial services that we used to solely provide, right? Just us and people that look like us, and now that's changed quite a bit. The other thing I think most people aren't thinking about is you're now in a digital arms race. So the largest and best financed financial institutions are doing all kinds of things. They're acquiring these companies, they're investing in them. They've got incubators and accelerators, they're partnering, they're building their own apps. And if we're not doing this, that gap is getting imperceptibly bigger and bigger every day. All right, so how do we deal with all this? There's really 4 things we need to pay attention to close that gap. The first thing is we've got to look beyond the next few quarters. Now, credit unions are better at this than the banks. Many of the banks are publicly traded, and they've got shareholders, and that myopia of focusing on this quarter's, next quarter's earnings, a couple of quarters from now, is really, really tough for them. You guys are a little bit better at that. But we can still be kind of stuck in the present. McKinsey talks about the 3 horizon model. We're really good at horizon 1. That's the stuff that's going to take place in the next 12 to 18 months. We're going to extend and defend our core business. So that's playing the game, the current game, as well as we can play it. And we're pretty good at that. But as the game's changing, we've got to build emerging businesses, and we can't do that unless we're creating viable options for ourselves. So this actually pulls forward from the future. Right, that Horizon 3 stuff, those fancy ideas that, oh, that's not going to mean anything. Well, maybe not now, but if we can invest a little bit and test and learn a little bit about that, it might mean something in the future, and maybe we build an emerging business out of that. I think no better place than here to quote Bill Gates. We always overestimate the change that will occur in the next 2 years and underestimate what will occur in the next 10. The key is to not let yourself be lulled into inaction. And that's our natural state. Gartner has a model that I think is useful. They call the hype curve. You have a technology trigger, and you get really excited about it, and it reaches what they call the peak of inflated expectations, right? We were there a couple years ago on Bitcoin. We're just about there on blockchain right now, maybe starting to fall off. And then a while you go, oh, whatever happened to that? Right, we're in an analytics conference, big data, right? Big data, big data. Well, how many have had transformational, absolute, massive change coming from your big data program? No, but it doesn't mean it's not valuable. So it crashes into this trough of disappointment, but eventually we go, oh, maybe the timing wasn't right, maybe we didn't have the right kind of ancillary services built to it, maybe we didn't really understand what the market wanted. We climbed the slope of enlightenment and ultimately to what they call the plateau of productivity. Now, of course, ideas don't take shape in a vacuum. So I think it's useful to look at the human side of this. In 1957, Everett Rogers discussed the diffusion of innovation. He researched this, interestingly enough, with seeds. He was in agriculture and looked at how seeds, some farmers were using these new advanced hybrid seeds, others weren't. Turns out it's pretty much a bell curve, right? You've got some innovators up on the front end, and the early adopters, early majority, late majority, and the laggards. And for whatever reason, he didn't call out that last second standard deviation on the right. I assure you it does exist, though. It's my mother-in-law. It's a true story. She used to tell us she didn't like to go to the ATM because it took too long. I said, well, what do you mean it takes too long? She said, well, I can only do it in $10 increments. You know what she was doing, right? Just putting the card in, punching in her PIN code, taking out a $10 bill, getting her card and receipt back, and putting it back in 10 times if she wanted $100. So we definitely have some real laggards. Now, my mom, on the other hand, a little bit younger than my mother-in-law, but not much. She'll be 80 pretty soon. And my favorite text from her iPhone 6 is, do you know if Skype takes PayPal? I need a new headset. So it's not all ages, but we have some of us like to adopt new ideas sooner than others. In 1993, Jeffrey Moore added a very important concept to this, and he said, that gap between the early adopters and the early majority is not just a gap, it's a chasm. And he wrote a great book called Crossing the Chasm. It's been a Bible of Silicon Valley ever since. And understanding early stage technology companies have to be able to cross the chasm to get mainstream success. I asked how many of you use Uber. Almost every hand in the room went up. You think about how amazing that technology is for a company that's been around for 5 years. They clearly crossed the chasm, right? Even my mother-in-law knows who Uber is. She's never ridden in one and she can't pronounce it, but she is aware there is such a thing. You put the two together and you kind of understand that some of those ideas kind of drop down through the chasm. That's what happens, right? The ones that go away, we're just maybe not ready for prime time and maybe never will be. And our problem is we're all on the right. We're right of chasm people, almost all of us. We probably have some exceptions in this room today, but if you go back to work tomorrow, look around, almost everybody is right of chasm. We call them trailblazers versus traditionalists. We have a lot more people that look like the guy on the right than we do the guy on the left. So let's talk about these people a little bit. The traditionalists want to manage the known knowns and enforce best practices. Nothing wrong with that at all. That's exactly who you want running your loan book and your audit committee and lots of other things. I'm not so sure it's the person you want running the enterprise any longer. I don't want to turn the keys over to this guy to run the enterprise either, but he wants to explore the unknown and discover next practices. And as you'll see in a moment, the best organizations really get the best of both worlds. If we lean too far towards the traditionalists, at worst, we get the business prevention department. Somebody came in here with an idea, but don't worry, I got rid of them. If we lean too far the other way, it becomes what I like to call innovation theater. Oh, isn't that cool? We have straight-through processing on the blockchain in the cloud. What does that even mean? And will our members even care? So it's not about either of those things. You know, the ancient art of manufacturing samurai swords is hundreds of years old, and they use a very high-quality, high-carbon steel called tamahagane. But if that alone were used to make a samurai sword, it would be too brittle. So they mix it with low-carbon steel and back and forth, and they fold it 100 times back and forth and blending the steel so they've got strength with flexibility. And that's what the most innovative organizations are doing, what I like to call the alloy organization. We've got a nice mix of those traditionalists, keep us from getting in harm's way for our members or our shareholders, any of our constituents. But at the same time, we're flexible and we're trying new things. So the second thing we have to keep in mind as we think about all of this is innovation is really about value creation. It's not about innovation theater. And this whole notion of disruption. And William Gibson famously said, the future's already here, it's just not widely distributed yet. And I think the same thing with disruption. It's easy to go, well, all this talk, I've been hearing guys like you at conferences for years, and we still have all of our branches, and we still have all these competitors. Look at all these people. This industry isn't being disrupted. Well, I think it depends where you look. At the deepest level, at the most fundamental strategic operating level, things like blockchain and artificial intelligence, we're in the very early stages of those things. And I think they could have some fundamental changes. And that's why you're seeing so much equity capital going into technologies like this. But the next ring out is really that tactical level. And then beyond that is really just that experience level. So many institutions are out at this experience level right now. We're putting laptops in the hands of advisors, and we've got a mobile app, we have all that stuff, and that's great. Those are important things. And listen, the innovation snobs will tell you that's not innovation, but it absolutely is, and it's absolutely important because that's what keeps the gap from getting too wide, right? That's what keeps you in the game. But that alone is not going to do it. So we've got to go a little deeper to the tactical level, so it's not just having the mobile app, but how do we link that now to re-engineered processes, and how do we do things like straight-through processing, and how do we build analytics off of all that data that we're collecting now? I mean, you know so much about your members. You know who they are and what they own and what they owe and what comes in and what goes out and when it goes and where it goes. And let's be honest, what do we do with it? Very little. I saw on Twitter yesterday somebody had tweeted out, quoted one of the speakers about crawl, walk, run. Couldn't agree more. And I would apply the exact same thing to any kind of innovation program. Try some small things, and we'll talk more about that in just a moment. But I think disruption is happening already at all of these levels, and you've got to really think about all of them. If we want to put this back on the Three Horizons model, so a lot of that experience stuff is really first horizon stuff. That's stuff we're caring about now and then the next couple of quarters, and then beyond that, we're trying to look and build those new tactics that might involve re-engineering of processes and so on, and then deeper than that, the stuff that we're not bringing forward just yet can really fundamentally change the game. So embedded in all of this is this notion of test and learn. I mean, I would not sit down at a poker table and push in all my chips and go, deal me some cards. I hope this works out. But why do we do that with our own technology projects and our own product launches? We sit around and talk to each other. We think we can get all the smartest people from our institution in a room, and we'll plan it all out, and we fill out a massive spreadsheet, and let's come out. We know we're making up half of those numbers because we don't know, and you're no different than anybody else because you're all doing the same thing. What you do in poker is you do the minimum ante and you see what your cards are and you see what's happening on the table. And if the cards are in your favor, you put a little more in. If they're not in your favor, you fold and walk away and you wait for another hand. And we've got to test and learn, whether it's an analytics project or an innovation program or digital transformation, that crawl, walk, run cadence that was talked about yesterday. This is really the essence of that, is testing and learning. We think we can plan it all out. Plan your work and work your plan. And, well, that doesn't work anymore. The great Prussian military strategist Helmuth von Moltke says, no battle plan survives contact with the enemy. Mike Tyson said it a little more succinctly. Everybody has a plan until they get punched in the face. What you want to do instead is what we call fast, iterative, responsive experiments. And we actually use that as an acronym to describe kind of the best of Scrum and Lean Startup and Lean Six Sigma and other agile methodologies in a way that works for financial institutions in a highly regulated environment. Because all those things were designed for software and manufacturing, other things that don't really work for here. So we've actually kind of blended that into a unique mix that works. And I like to think of it as the power of One Sigma. Now, all this talk about Six Sigma, and that is awesome when you're executing a known strategy, you're executing a known solution to a known problem. But the idea about innovation and test and learn is it's not so well defined, and that's exactly why we're testing and learning. So the power of One Sigma, that looks like something worth taking forward. Let's get it to our members now and see what they like. Let's not wait until we get it all loaded and we've got 18 months worth of expense and anxiety and PERT charts and Gantt charts, and then go, turns out they didn't really like that much. And oh, by the way, 3 of our competitors launched something completely different, and now the technology has changed. So let's not be afraid to test and get those things out there sooner rather than later. Okay, third thing we have to do is be willing to partner. We don't have to invent it all in-house. We're probably not. I see very, very, very few institutions globally, financial institutions, who will be product leaders. Very few. And that's okay. You don't have to be a product leader. The chairman of one of the largest financial institutions in the world says, fintech startups are very good at reducing the pain points, and that they can make loans in minutes, which might take banks weeks. We're going to work hard to make our services as seamless and as competitive as theirs, and we are also completely comfortable with partnering where it makes sense. Now, you'd think if anybody could afford R&D and product development, it would be JP Morgan Chase, and it is, and they are doing those things too. If you recall back to the other slide where we looked at some of the largest financial institutions and what they're doing, all different kinds of strategies, but one of them is partnering. Why should we partner with fintechs? Well, one of the things that you have in your advantage is, here's the B word again, customers trust banks. This is a specific bank survey. And credit unions have an even better advantage. They trust you even more for a whole bunch of good reasons, right? 96% of people asked they either completely or somewhat trust their bank. What do you think that number is for fintechs? Anybody have a guess? 24? 90? Head of the class. Yeah. Yeah. That's all right. It's not cheating. No, it is surprising, I think, to a lot of people that, again, this is kind of back to the mini mills. Our customers wouldn't want that. Our members wouldn't want that. They don't trust that. I'm not so sure. And then when asked, well, would you refer a friend? 50% of people said, yes, the bank customers, we'd refer our bank to a friend. 63, almost 64% said they would refer their fintech. So the game is changing. So some of you may be saying, we partner. We have a procurement department. We got some tech vendors. I don't think that word means what you think it means. It's not really partnering, right? Asking, that early stage company to indemnify your multi-billion-dollar institution and, the 50 pages of vendor due diligence. I know you've got to do all of those things, but we got to think about it a little differently. We got to put the gates in the right order. Right? And let's not just get all the way down to here before we can even test anything. Because you all, and again, I'm using the B word on you here, I apologize, but in this case, your bankers and you guys are on different planets. Right? You just speak fundamentally different languages. And so what happens in a lot of partnerships is they focus on the technology, which is absolutely important. Right? It's got to be compatible. Slot A has to fit into tab B and all of that stuff. But that's just table stakes. That's necessary but insufficient. We also have to pay attention to the culture, the cost, and the compliance. You guys understand compliance really, really well. The best fintechs do too, but many don't. And you guys have to manage this. This move fast and break things ethos of Silicon Valley doesn't work in a highly regulated environment in which we operate. So we got to get better at partnering. And last thing, innovate as an act of leadership. You all are leaders. The most important part of your role in my book as a leader is the appropriate allocation of resources. Human resources, financial resources, managerial time and attention. This stuff doesn't just happen. You have to decide that we're going to innovate, and we're going to try new things, and we're going to move forward, or it won't happen. It doesn't just happen on its own. Some of you know Ron Shevlin from Cornerstone. He has a great quote here. Stop trying to create a culture of innovation in your organization. If your firm obsesses over providing great customer service and value, it will find ways to innovate. And I think this is a way of kind of saying what Peter Drucker said many years ago. Management is doing things right, but leadership is doing the right things. Another way to think about this is by thinking about innovation, what's close to what we're doing already, existing products, existing members, existing regions, and that sort of thing, and that core innovation. So that incremental kind of stuff that we're doing that just improves, anything we can do to make, fewer clicks on the mobile app, or, can we link that into a way to be able to finish it in the branch if they want to come visit, but be able to complete it digitally if they don't, right? All those little things are kind of just incremental. And again, the innovation snobs will tell you that's not innovation. They're actually crucial. And as you begin to get out a little bit over your skis, those more kind of adjacent innovations are riskier, and then the transformational things are really out there. So as you move away from the known knowns, it gets riskier. And most institutions are going to spend most of their time in the core, and that's absolutely right, and a nice balance between that. It really kind of depends on a whole bunch of things unique to your institution. But there was a research study done by Monder Group in 2011, and wanted to see if there was a magic ratio about how you spent your time and money across your innovation horizons. And The short answer is no. There's not a magic number. It really depends on where you are. But the little bit longer answer is, if you wanted a place to start, something about 70, 20, 10. Turns out that's exactly the ratio Google uses. So about 70% of your time and effort on those core, more incremental kind of innovations, 20% adjacent, 10% in information, in the transformational quadrant. That makes sense in terms of kind of total value. But if you actually look at the return on innovation, turns out it's exactly opposite. All that stuff you're doing, that 70% of the stuff in the core, is probably only about a 10% improvement. The adjacent stuff is pretty good, bang for the buck, about 20-20. And that little bit of 10% stuff that you're doing on those crazy moonshots, that's actually where 70% of the value comes from. Because Wayne Gretzky was famously quoted as being the best hockey player ever because he skated to where the puck was going, not to where the puck was. And that's what innovation leaders are doing. How many here have a chief innovation officer at your institution? Anybody with that title? You do? Yeah. Is it word innovation actually right in your title? All right. Awesome. Glad you're here. You're the only one. Most of you have what I like to call and-I's. And somebody with and innovation kind of tacked on one more over here. So I missed you. We're all right. Great. Glad you're here too. All the rest of you either have it unofficially or kind of penciled in or tacked on to your job title or kind of implicit in your job description of and-I. Oh yeah, I'm head of digital and innovation. All right, head of technology and innovation, whatever it is. And that's okay. Most institutions can't really afford somebody to have that as their full-time job. But and-I's need love, and they need support. They don't have a lot of resources. In many cases, they don't have a lot of training and understanding that managing innovation is different than managing the core business. These are the Mohawk guys we looked at earlier. And we've got to support them because they're really the person that are trying the new things while we're executing today's business and making sure that we're doing a great job for our members today and tomorrow. These are the people that are creating those viable options for us and building the emerging businesses. So here's where we are. You have a couple decisions to make. Do you buy all the stuff I said about this is a whole new landscape and the old map doesn't work anymore? Or do you think, no, he's full of crap, old world order will continue to prevail? And then you have to decide, well, do you want to do something about it either way? You can do nothing or you can take action. So you can double down on existing strategies, similar to what Bethlehem Steel did. May work for a while, may work for a long time, may work forever, probably not. You can hope this is all a temporary fad and maybe it'll just go away. You can just give up and kind of give way. Well, we'll just focus on this and we'll let FinTech do other people. Our members don't want that. Or you can embrace and engage and partner with new players. Because I'll tell you this, the best way to predict the future is to create it. Thank you very much. So I have these slides available if you're interested on my website. You can download them here. And I've left a couple of minutes for Q&A if you have any. I would be happy to take your questions. So.
Any questions for JP Nicols?
We have a question here.
Can I ask a quick question?
Sure. Hi.
Hi, Shrikant, analyst, First Tech, digital analytics team. I would actually like to give opportunity to other participants, but I just thought of asking this. The last statement you made about, taking innovation, disruption. My question is, what exactly is your take on blockchain, and why do you think that has a lull? Because it has all the elements what you presented, like the Ubers, trying to make a guess.
Yeah. So what do I think about blockchain?
Right.
I quite easily may be the least technical person here. Right? I've never written a line of code in my life. Technology is just a tool for me. I'm very interested in blockchain because if you think of this notion of distributed ledgers, the underlying technology, we're in the ledger business. You have a ledger, and you have a ledger, and you have a ledger. And if you want to transfer money from one place to another, you got to take it off of your ledger and credit your ledger over here. And then we've all got to agree that the value and all that stuff. And suddenly that stuff is in one location, right? One publicly shared distributed ledger that we all see and know and agree to and all of that. And traditionally, our role was that of a gatekeeper. If you wanted to borrow money or save money or invest in the market or move money or whatever, you came to some sort of financial institution. And those barriers have been going away for about the last decade. And you think about the power of blockchain to really change that and really democratize the ability to move not just financial data, but all kinds of data. I'm really intrigued by some of the use cases around things like trade finance, where you've got a shipment that shows up somewhere halfway around the world and a bill of lading that's on there, and then the ability to embed a smart contract into that to be able to say if these conditions happen, then do that, which is release funds and all of that. Now you're talking at a very fundamentally deep level of changing the business model, not just putting a digital wrapper around it, not just improving the process or taking the friction out of the process, but fundamentally changing it. So I think there's some very interesting implications of blockchain. I think we're still very early. You've seen a lot of money went into the R3 consortium, then money's coming out of the R3 consortium right now. Particularly publicly traded banks, they're getting very impatient about this notion of innovation theater I talked about earlier, and we don't see any links there. It's been very interesting to see what SWIFT has done, like global bank transfers, and they're paying a lot of attention to blockchain, and Ripple's got some use cases around that. So I think it is fundamentally one of the most potentially world-changing technologies we're going to see in the rest of my career for sure. Sure.
So we have another question from the audience.
Yes.
Is there a recipe of getting to the right strategy and innovation, and where to start from?
Yeah. So anonymously asked. Somebody didn't want to show their hand on that one. So is there a recipe? No, there's not a recipe. There's your recipe. Right? And I think the most important thing is starting with your members, right? And really understanding who your members are and who they are and who do you want to be members that aren't currently and all that. It's not about chasing the technology. It's not about making the headlines with things. I shared the Google ratio, right? That's a great place to think about it, that we should be spending most of our time kind of making incremental improvements. And again, I know building on what I heard about your conversations yesterday, the same thing around analytics, right? This notion of, well, we can't do any of that until we build this massive data lake and all this stuff. And, if you're here for the big Hadoop versus Spark debate, you're probably in the right place, but I'm the wrong guy. Right, it's not about all that kind of stuff. It's really thinking much smaller about your members and that test and learn environment. I would say build a hypothesis. We think our members want this. Let's test it as soon as possible. What the MVP, the minimum viable product, what's the minimum thing that we can use to get this out in our members' hands right away and test and see, and then build from there. And your recipe will kind of follow, right? So don't try to plan it all. Don't write the recipe first, then start to cook. Right? What else?
Any other questions?
So, is there a starting point, meaning what might be that starting point in your view, where, because I think a lot of people over here are sitting right on the edge, right on the fringe, and what might be that point where they should start thinking that this might be the low-hanging fruit that we should probably go after first?
Yeah, low-hanging fruit or where to start. I think I'll double back on what I just said before, right? Starting with the members. And then maybe to take that a point deeper is don't just ask them what they want. As Henry Ford supposedly said, if I would have asked my customers what they wanted, they would have said a faster horse. Steve Jobs famously did not like to talk to customers. Customers don't know what you want until you show it to them. So and they don't know what they don't know. But if you really look at their behaviors, and this is one of the reasons why analytics is so interesting and exciting, is you find threads to pull on. So if you look at the things that they're doing, and yes, have some conversation by all means along the way, but don't stop at conversation and take what they say at face value. Look at their behaviors and look at where there are pain points that maybe they don't even articulate. They don't tell you it's a big pain, but you've noticed there's a workaround, Oh, they've created an Excel spreadsheet to do this because the data coming off of your online banking doesn't provide what they want to do. Well, that's a great place to start. As soon as you see somebody doing a workaround or something like that, very famous story about how Cannondale got in the mountain bike business. There was no such thing as a mountain bike, but people were riding their bicycles up and down mountains and totally unsuited. They were stripping off shocks and other parts from motorcycles to make it more conducive to that. And some guys from Cannondale said, well, isn't that interesting? And build a multi-billion-dollar category out of it. Another famous story, you may have read about this one, P&G and the Swiffer. Right? P&G thought what they needed to invent was a better mop. But what they really began to find out, again, no customer said, you know what the problem is when I'm mopping here, then I'm messy and I got to kind of change into my cleaning clothes because I'm going to have sloppy mop water around and all that stuff. It took them 3 months of ethnographic research, of actually spending time with customers and people understanding it's not just how do we get a cleaner floor, how do I get a clean floor and not make myself a mess in the process? And so it wasn't a better mop, it was creating, again, another multi-billion-dollar category, talking about building an emerging business, this idea of a Swiffer, where we've got these pads with, squirt the stuff on there, so completely different. So talk to your members, but do more than talk. Look at their behaviors and try to find those pain points and those workarounds. Yes?
So you were citing Professor Christensen with regards to a disruption and the low-end disruption of the steel mills. Do you see the fintech companies and what they're producing as something that's sustaining, or do you see that as a new market?
So a little bit of both. I think mostly, why I say we're at the rebar stage is I think mostly what they've chipped away at is that outer layer, that experience layer, is finding the things that haven't worked very well. Some of you may know the story of Simple. Started just down the road in Portland, Oregon. Josh Reich sent an email to Shamar Kirkle saying, what if we build a bank that didn't suck? How's that for a mission statement? Pretty simple, right? The bar is pretty low. Every bank sucks. How about if we build one that doesn't? And if you think about this time in 2009, this is when every bank is cranking up the overdraft fees and we process your checks highest to lowest in multiple days, and we could get another fee and we can raise that fee and all of that. Created a lot of angst and pain, and that was all okay when the banking industry could say, what are you going to do, go to one of my competitors? They're doing the same thing. Now, you guys in the credit union industry were already trying to address that. But suddenly, Simple and others, and many others, this neobank, the idea of starting with what was pretty simple, it was a prepaid Visa card, but they didn't say, some of you offer prepaid cards. It didn't say, hey, would you like a prepaid card? They actually worked from the customer pain point and build a whole customer experience around that. So most of what's happened in fintech today has been kind of at the experience level. Some research and things going on at the deeper level and certainly around blockchain and sort of that. Are there new markets opening up? I think so. I think most of it has not been yet, but I suspect that we will. What else? Last call? Okay, thank you very much. Thanks for having me.